brutal truth about your credit score and why it's holding you back. Two brilliant minds, one a mathematician and the other an engineer, Bill Fair and Earl Isaac, founded FICO in 1956. They had just one revolutionary idea: to take the subjectivity out of lending and replace it with data-driven decision making. These guys believed that statistical models could predict whether a person will repay a loan regardless of who they were or where they came from. If you're familiar with a little bit of American history, you will know that the late 1950s was a very pivotal moment. At this point, the US is having a great time riding a wave of post-war prosperity. The economy is booming, the middle class is expanding, and for the first time, consumer credit is becoming a central part of American life. But there is something most people don't know. This was also the time when groundwork was laid for a system that will shape your financial future in ways you might not even realize. The birth of credit scoring. Credit back then was a luxury reserved for the wealthy. It wasn't something everyone had access to. But as credit cards became more common, so did the need for a way to measure people's creditworthiness. That is when credit scores began to take shape. Now, fast forward to today, and credit scores have evolved into one of the most powerful tools in the financial world. They are practically the gatekeepers of opportunity, or if you're not careful, the very thing that can hold you back financially. And here is another thing a lot of us forget. This system, the credit scoring system, which was built in the middle of the 20th century, wasn't designed with everyone in mind. In fact, people of color and immigrants have historically been disadvantaged by this system. So today, we're going to have a no-nonsense discussion about your credit score, why it might be holding you back, and how you can take control to live the life you truly deserve. I will start by breaking down what a credit score actually is. Basically, a credit score is a 3-digit number that represents your creditworthiness. That's just a fancy way of saying how likely you are to repay borrowed money. Here in America, the most commonly used score is the FICO score, which ranges from 300 to 850. A score above 700 is generally considered good, while anything below 600 is considered poor. But you will think, since this sounds so important, many people should understand how it works. But no, you'll be surprised, you're wrong. You will be shocked at the number of people who still don't know how it is calculated. Your credit score is made up of 5 key components. Your payment history, which takes up about 35% of the entire score. This is the most significant factor, and it's about whether you pay your bills on time. Late payment, missed payment, all of that can all drag your score down. The next 30% is covered by credit utilization. This typically measures how much of your available credit you're using. The higher the percentage, the more it can hurt your score. Even if you're making payments, then length of credit history takes another 15%. And normally, the longer your credit history, the better it is for your score. Another 10% is determined by new credit. What this means is that every time you open a new credit account, it can cause a small dip in your score, especially if it is done frequently. Then the last 10% is determined by credit mix. This just means that lenders like to see that you can handle different types of credit, like credit cards, mortgages, and car loans. So those are the 5 components that make up your credit score. For someone who is an immigrant, credit score challenge may be something you're not prepared to face. When you arrive in a new country, you bring your skills, your dreams, and often your savings. But there's one thing you leave behind. That is your credit history. In the US, no matter how stellar your financial record was in your home country, you start from scratch. And this system, let's be honest, wasn't designed with immigrants in mind. Let me give you a bit of history around this. Back in the 1970s, there was something known as redlining, a discriminatory practice where banks would refuse loans to people based on their race or the neighborhood they lived in. And this practice was also very legal in many parts of the US. You're shocked, right? Well, it did happen, and it's not all gone. What happened was that people of color and immigrants were systematically excluded from the credit system. Even after these practices were outlawed, the legacy of discrimination left deep scars that persist today. According to a 2019 report by the Federal Reserve, Black and Hispanic Americans are still more likely to have a lower credit scores compared to their white counterparts, often due to a lack of access to traditional banking services and credit building opportunities. And there are real-life consequences of having a poor or non-existent credit score. Now, imagine you've just moved to the US and you're ready to start your new life. You found a job and now you're looking for a place to live. But there's a problem: your credit score. Or worse, you don't have one at all. You apply for an apartment, but your application is denied because the landlord can't verify your credit worthiness. This happens more often than you would think. 43% of landlords used credit scores as a key factor in rental decisions, and that is from a study by TransUnion. You know what that means? Even if you have the money to pay the rent, a low or non-existent score could be the deal breaker. And it doesn't stop at housing. Many employers in the US run credit checks as part of the hiring process, especially for positions that involve handling money. According to the Society for Human Resource Management, nearly 47% of employers conduct credit checks on applicants. Again, this can be a huge barrier for you as an immigrant who is already facing challenges adapting to a new culture and a job market. And it doesn't end there. In 2020, a report by National Bureau of Economic Research revealed that people of color are more likely to be penalized by credit scoring algorithms. And these are algorithms that are supposedly designed to be neutral. But the reality is they often reflect the biases inherent in the data they are trained on. For example, one study found that African Americans were 80% more likely to be denied a mortgage compared to their white counterpart, even when controlling for factors like income and loan amount. A whole 80%. But let's go deeper. In the 1980s, the US experienced a wave of immigration that highlighted a critical gap in financial literacy among newcomers. Many immigrants struggled because they didn't understand the importance of credit in their new country. The lack of a credit history also meant they couldn't access the same opportunities as others, which led to systemic financial disadvantages that have persisted over decades and resulted into what we see today. The problem with the credit scoring system doesn't end there either. There is also a financial impact of poor credit. If you have a low credit score, you're going to pay more for everything: loans, insurance, even utilities. And this is what happens. Lenders see a low credit score as a higher risk, so they charge you more in interest to compensate for that risk. Let's say you're trying to finance a car with good credit. You might get an interest rate of 3%. But if your credit is poor, that rate could jump to 10% or more. Over the life of a 5-year loan, that difference in interest could cost you thousands of dollars. And it's not just about loans. According to a report by the Consumer Federation of America, drivers with poor credit scores can pay up to 91% more for car insurance than those with excellent credit. That is money out of your pocket, simply because of a number. Now, let's switch gears for a moment and talk about the psychological toll of poor credit. We often think of credit as just a financial tool, but it's much more than that. Living with bad credit can be incredibly stressful. It can lead to anxiety, depression, and a feeling of helplessness. You start to feel trapped every time you are denied a loan, every time you're charged a higher interest rate. It's a reminder that you're not where you need to be. This is particularly challenging for immigrants who are already dealing with the stresses of adapting to a new culture, learning a new language, and building a life from scratch. Adding financial stress to that mix can make the adjustment process even harder. It's even been found that financial stress is a significant factor in the mental health of immigrants. A study in 2018 showed that immigrants who experience financial difficulties, including poor credit, were more likely to report symptoms of depression and anxiety. So when we talk about credit scores, it goes beyond the money involved. It's also about quality of life and mental well-being. Now, understanding everything that is at stake, the question you should have on your mind is there a way to fix this? If not entirely make the problem go away, at least can I have some semblance of control over it? And the answer is yes. It's not going to be easy, but it's absolutely doable. You can either get a professional help from people like me or work towards learning how to do it yourself. If you will be doing it yourself, it all begins with getting very hands-on, and to get hands-on, you need a copy of your credit report and look for errors. Believe it or not, 1 in 5 credit reports contains errors that can be disputed, and according to the FTC, disputing these errors can give your score a quick boost. Also, as an immigrant, you need to start building your credit history as soon as possible. I know for newcomers, everything is new and overwhelming, but listen to me very carefully. If you don't have a credit card, consider getting a secured credit card. It will make a huge difference for you in the long run. For secured card, you will be required to make a deposit that acts as your credit limit. Once you have the card, use it for small purchases. Pay off the balance in full each month, and over time, you will build a positive credit history. Like I mentioned earlier, your payment history makes up 35% of your FICO score. So make sure you're paying your bills on time every time. Even just one late payment can hurt your score. So set up automatic payment if you need to, whatever it takes to ensure those payments are made. I personally have an app I use to track my payment. There are lots of them out there that you can find. So find one that works for you. Now here is a note of warning though. Don't apply for too much credit at once. Each time you apply for a credit, there is a resultant dip in your score. So you have to be strategic about when and where you apply. Then there is also the part about building good credit habits. I said this before, but I will say it again. Keep your credit card balances low. High credit card debt can significantly lower your score. Aim to keep your credit utilization below 30% and if possible below 10%. And just keep in mind that credit is a long game. It's not about quick fixes. You need consistent, responsible behavior. If you can commit to that, your score will improve and so will the opportunities available to you. So the bottom line is, your credit score is more than just a number. It's a key that can either unlock doors to new opportunities or keep them firmly shut. And you definitely don't want to do that. If you know you can't do it on your own, get the help you need. No one else is going to do it for you. The odds may be stacked against you, but you're not entirely helpless. With the right steps, you can take control of your financial future and open up new opportunities you never thought possible. Thanks for watching today. And if you found this video helpful, don't forget to like, subscribe, and hit the notification bell. Till I come your way again, keep making smart choices. Bye for now.